All right, well, welcome back to another episode of How to Make Money with Hard Money. As usual, joined by my partner, Caleb Delgado.
Yes, sir.
So today, you and I are going to chat about the market. We just got back from the NPLA, the National Private Lenders Association conference in Miami.
Yeah.
I know you and I have been speaking a lot about our takeaways from the conference. We got to hear some CEOs and some big private lending companies nationwide, and got to hear a lot about the market. Right now it's early April 2025, so I think that timestamp will matter as the market's shifting.
Yeah.
I mean, the tariff news and everything is changing weekly at this point, so daily,
hourly.
Yeah. So we were in Miami. I mean, we had a little bit of fun too, right?
Yeah, I would say the atmosphere in Miami is second to none in this world. It's its own little world in the United States, I would say, and the restaurants, the people, the energy. It's amazing.
We got to, Austin might have had too much fun at Poppy Steak, but
Poppy Steak, yes, that's a great restaurant. We definitely ordered the beautiful tomahawk and enjoyed that.
We got to see some good friends too, that from previous years. So I love that community. It's really growing. It's special to be around just individuals that are like doing exactly what we're doing to true private lenders, and it's a good mix. I mean, there was a lot more brokers this year.
That was an interesting piece of the amount of brokers that were allowed, because typically they don't have really brokers. It's a lender or servicer.
Yeah, they didn't allow brokers at all last year.
Right. So it's a good component. I believe that's a good mixture to have, seeing their perspective and then seeing what they're facing. I mean, they're ground level.
Yeah. There's definitely differences to having brokers there. I think there was something special when there weren't brokers there, when you're just like true lenders and service providers only. I like that a little bit as well. Not to hate on the brokers. We love them as well. But
well, that's, your side and my side of the business. I love the brokers a little bit, and I'm, because I considered myself one at one point.
Yeah.
So I can have that connection with them. But
yeah,
it was good.
No, so I guess that kind of ties into the whole narrative, I suppose, huh? So
yeah, I think the best way to start is, what were our takeaways or in general of the whole conference?
Yeah. So, the big headline is the securitization of hard money loans. So right now, it's a very changing market in hard money, or they were calling them NTLs or RTLs, sorry, residential transition loans. And so getting away from the hard money lending, we're not going anywhere with that term of how to make money with hard money, but it's the securitization of hard money loans right now. And so it happened. We mentioned it last year when we had the previous podcast after the NPLA.
Yeah.
They had just completed their first tranche of hard money loans. It was like $250 million at the time.
Yeah.
And essentially the tranche is like packaging up a portion of loans and then selling them on the secondary market.
Correct.
Which traditionally never happened. Years ago, it was very private. People are using their own capital. They're holding the notes, they're servicing them, collecting the interest on them. But now there's this whole securitization where they're packing them up in tranches and then selling them on the secondary to recycle capital. Right. So it's very interesting. And that happened. It went from $5 billion to $8 billion. And now this year they're expecting $12 billion to flood the market. So, I mean, that's a lot of capital coming in to the private lending space.
Oh, no, it's a tremendous amount. And it's really changing the landscape overall. One, obviously it affects cost. And it affects loan products. It affects everything.
Everything.
And being able to identify, the ability to sell the loans. Because before, it's what did everyone believe a hard money loan? Some loan shark sitting on the corner that you get a private loan from with no qualifications. And if you don't pay, you get your legs broken.
Right.
These guys were able to qualify these loans, put them in boxes for the ability for insurance companies to purchase.
Yeah, like grading them, like the mortgage-backed security days, like as you know better than anybody.
Yeah.
Right? So you're like grading paper essentially. So like that's like an issue. Who are the people buying them is a common question that I don't think, the flippers and the builders really get to hear about a lot. And so like who is buying these? Like right now, the number one buyer is the insurance companies.
Yeah.
There's a lot of private equity as well, but the insurance companies I think are the number one buyers, like the AIG, the MetLifes, the Mutual, these massive insurance companies that are looking for returns, just passive returns, are buying up tranches in $250 to $500 million at a time.
Yeah, and what would you say? Because what was the difference of before and now that why they would want to buy them? Like, why weren't they attractive before? What would be the main difference, you think?
I guess they were difficult to grade the paper, really.
And how do you believe that they're grading them?
Well, that's a great question. I mean, and that's why I love what we do as traditional. I mean, we're considered traditional hard money lenders because we're not really fitting this box of being able to sell. So we're not selling, to clarify, we're not selling our loans. We're not selling them on the secondary. We don't, we call them institutional hard money loans.
Yeah.
But, in the market, that's pretty controversial, whether they're traditional hard money or, now just modern day hard money.
Yeah.
So we hold our notes and we don't qualify credit appraisals, experience, liquidity. Those are probably the top four, would you say?
Yes.
Credit appraisals, experience, liquidity.
Yes.
If you have to check certain boxes in order to qualify or grade your paper to then be able to fit into a tranche and sell the note.
Correct.
And so that's why, you Google hard money loans and you're seeing all these companies like Kiavi, Lima One, and Cap Source. I mean, there's thousands of them.
Oh yeah.
And to me, they're pushing very similar products.
Yep.
But there's not a lot of wiggle room or creativity. And that's what we pride ourselves on, is the creative portion.
Oh, for sure.
Traditional asset-backed lending, we're saying, what's the asset worth? Here's the loan to value. We'll lend to you. No credit, no experience, no liquidity, no appraisals.
Yeah.
They say they're asset-backed lenders, but when you're asking for credit, to me, you're qualifying the borrower as well.
Absolutely. I think that definitely caters more to the traditional side in general. But, with that being said, is where do you think we're going now that there is all this capital? They've been able to sell and securitize these loans. Where does that fit DKC, and how do we become beneficial to the market? Because I think we recognize personally, what a different product we provide.
Yeah, no, there's no doubt we're filling a niche, because if you're not qualifying for, I'll say the benefits, to not sound like I'm beating them up, but I mean, the benefits are they're providing higher leverage, if we're 30% down payments, some of them are 10% down. So you can bring 10% down. So it's higher leverage. And sometimes the rates and terms are lower.
Yes.
So you can get lower interest rates. I mean, the margins are tight. I mean, you're not getting, on a new construction loan, for instance, the highest quality borrower I haven't seen get lower than 10 and a quarter. And we're 12. So you're not talking about, it's not like you're getting bank terms at 6-7%.
No.
But if you're getting 10 and a quarter versus 12%, you're getting a better rate. You're getting maybe fewer points, but you have to submit far more documents. You have to qualify, and speed of funding and convenience. I think these are where we provide a lot of value to borrowers, even whether you qualify or not. I think we have borrowers that qualify for the institutional hard money product, but still prefer to use us because of the flexibility, the creative nature of and efficiency of how we process loans.
Yeah.
But so there are benefits to the institutional side.
Yeah.
On the private side, I think that's where, if you cannot fit into that bucket, and you can't, if it's credit appraisal, experience, liquidity, if you're not fitting into that bucket, then you're going to have limited options, and you're going to need a traditional asset back lender.
For sure. And I think also the deal they're negotiating, that's a big thing that I took away personally, was how you can negotiate each product. Because we're firm believers that no matter how good we are in sales, and I'd like to think myself and our team in general are great sales guys, but in the end, the deal is going to determine what product it needs, right?
Absolutely.
And I think when negotiating, one of the biggest, yet again, takeaways I took back is, with our flexibility to close and the speed to close, you might be able to negotiate better purchase prices and better terms on your acquisition, which can compensate for the savings that you would get by going to those traditional lenders. And then you skip all the documentation.
Yeah.
So there are major benefits, and there are definitely hard line separations between, traditional asset-backed lenders like DKC and these institutions, I would like to call them.
Yeah.
But
I'd even add the convenience portion. I mean, we have borrowers right now who are like, yeah, we qualify for that product, but I don't feel like submitting my entire life in 1 million documents and going back and forth and being subjected to third-party underwriting. If you call us and we are the underwriters, we're underwriting the loans ourselves, and we're not selling them when we're servicing the note. You can speak to the same group of people that originated the loan that's going to service the loan. And so who you're dealing with. You get to build a relationship. We've talked about that before. I mean, if you're dealing with a nationwide lender, who are you speaking to? It's, we're a local private group. So I think there's a lot of benefits to that as well.
Yeah. And then also too, like they securitize and sell it off. Well, who are you making your payment to? What's that relationship like?
Yeah.
If anything happens, or, like we all know in real estate, there's always issues. There's always adjustments we got to make.
Oh, the extensions portion. I mean, today's market, we've seen such an uptick in extension requests to extend the term of the loan.
Yeah.
And so, we know that some of those institutional hard money lenders are not very flexible on their extension terms. And if
they're not
very expensive.
Really, the one thing we learned is there is basically no flexibility.
Yeah.
They send you a notice and your extension's here. It's this or this, take it or leave it.
And understanding the source of funding is key for a borrower to make the decision. Because like I said, there are times where you may want to and should get the institutional private hard money loan.
Right.
But understanding the situation and why you may look for an alternative is key, and knowing where the source of funding comes from is pivotal, because when you're talking about hard money lending or private capital versus institutional, they may not be able to make an exception because they're selling the note and they're selling it on a secondary. So they have to check the box to be able to push it.
Right.
And so as much as they like you, they may not be able to make that exception. Some of these lenders also have, hybrid products, but I mean, it's a big deal. And then understanding where the market goes from here. I mean, they're driving costs down. The more money that floods in, it's a supply and demand, as we know. And the more money that floods the market for these types of loans, that's the other thing I saw is very competitive.
Right.
Very, very, very competitive.
Right.
So for us, we feel like we don't have to compete as to that high of a level.
Of course.
Because our product's different.
Yeah. And I think that's
Filling a void.
Oh, we're filling a massive void. I mean, how many of our borrowers need to close in 72 hours? They can't do that.
Yeah.
And not even 72, I say a week.
Or exceptions on speed of funding. Today's market, to be fair, it's like how many times you need to close in 3 days in a buyer's market.
Right.
So I think the exceptions are even more important.
Yeah.
Like we're closing a loan tomorrow with a open permit that can't be closed on a driveway.
Right.
Like there's code violations that need to be resolved through a draw schedule. And so, can they make these types of decisions, or even on insurance exceptions and things like that, the creative nature to get deals closed?
It's pivotal. And these tough markets, you have to be flexible for those changes to be successful. And we all know that. And as confusion, or I wouldn't say chaos yet, but we all know it's an uncertain market.
Yeah.
But we believe uncertainty equals opportunity.
Absolutely.
And the more creative and flexible your funding sources are, the more availability there is for you to capitalize on creative real estate deals.
Yeah. Yeah.
Right. So,
No doubt.
If you're an investor that fits the box, or you want to fit the box, fine. Those products are available. But at the end, when you get the opportunity to close a creative deal that, for us, how many times do we cross collateralize multiple different asset classes? Even
firsts and seconds and multiple states, and
how do you go to a lender and you have a fourplex and then you want to collateralize, a commercial, multifamily product?
As a second mortgage.
As I say, who are you going to that's going to underwrite that and understand the cash flow?
Yeah.
And, the difference.
I guess another takeaway from the conference is like their operationally, their efficiencies that they're pushing, which is a great thing. And I think for everybody for your private lender to be more efficient in draw requests, underwriting, processing. We heard somebody talk about appraisals, like they're driving the time down on appraisals.
Yep.
I don't think in a couple of years from now, it's not going to be a 3 to 4 week appraisal turnaround time. Even today, there are companies that can turn around appraisals in 3 to 5 days.
Yeah.
That never happened before. It used to be 3 to 4 weeks. So like there's all these efficiencies that are being created. We felt like we've adopted a couple on draw requests specifically. We feel like we're pretty capable of efficient draw requests and modifications, but that can also come at a cost, right?
Look at the what they did when you're talking about appraisals. Look at what they did with some of the desktop softwares. They have additional comprehensive testing that make them official like appraisals. And all they are desktop softwares.
Yep.
And banks are accepting them. Yep. So how does that affect appraisers in general? That's a big adjustment. But what would you say? Because I know we've adopted several, operational things, like we're talking about lien releases, satisfaction, servicing, all those items. There's not all super separation between us and them. What would you say on our operational side that we use that the other lenders look at as well?
Well, I think that, like I was going to say, there's a cost that can come with like pushing, like, because there was such a big emphasis on like reducing your overhead and reducing your cost to optimize. Because also when you're more competitive markets to get capital out, you're reducing your margins, right? So you're making less money, and you need to then drive down operational costs to still maintain profitability. And so there can come at a cost at that. And I don't know that it has, but I definitely know borrowers who have had poor experiences with some of the lenders. And I'm not saying we're perfect. We've definitely had, we're constantly aiming to grow. And I'm sure there's some borrowers who can say we can improve in areas, but
of course.
I think we're always aiming to do that. And we take that very seriously to try to provide a great service. But, when you're driving costs down, and we could be, and we take a lot of pride with that, is like, we definitely have more staff because we want to have customer service at a high level, you know? And so when you're driving costs down, I wonder where it's going to go if you're using AI for everything. Is like, where's the human connection gap? And I don't know, you know, I don't know where that is lost, but I know that our borrowers do love speaking to us and being able to have a problem solver on the other side and not be sitting on a call queue with a AI, you know, timetable telling you when your loan's going to be approved.
Oh, yeah. I mean, going to that and the simple things. I mean, how many times that we're going to request payoffs for deals and a previous lender never did a satisfaction and we got to chase it down and we have to make those adjustments.
Oh, yeah.
Those little things where people think, you know, the hard money business is just like, oh yeah, you could just call a guy and it gets done. That's not it too. We watch the back of our borrowers, make sure those code violations are handled.
Yep.
We're actually reading the title reports. We're, you know, getting updated reports that their insurance is valid. I can't
sourcing insurance quotes for them, trying to help them on their costs.
How many calls, if I go through my phone and how many costs I get, Caleb, thank you so much for you and your team forcing us to have this type of insurance. The 2 hurricanes hit. We got a massive insurance check and we normally don't even carry it. But because we showed them why, the importance, how it protects investors and them, were huge benefits to our clients and also prevented us from losses or our company from losses.
For sure.
You know, so us adopting a lot of, you know, what these hybrid hedge fund lenders are providing, but at the same time, keeping the customer service and the convenience of hard money lending on the table has been huge for us as an organization.
No doubt.
And I know you're the leader of that in our team, finding that balance between both of us. It's been a really big, good effect for our borrowers, I believe.
Yeah. And like you said, to our investors as well.
Yeah.
Because at the end of the day, it's capital protection. So you can stay in business and keep lending. Right?
Yeah. Yeah.
So let's talk about impact of securitization.
Okay. What do you mean?
I mean, where could the market go? And, you know, I guess one of my takeaways was around like the over securitization, perhaps, that nobody really knows yet. So maybe it's more of an opinion piece, I suppose.
Okay.
But like I learned a little bit more about how the securitizations work. And so if you're going to package, because it made more sense to me on like a DSCR loan, like a 30-year mortgage, and like, okay, you package up $250 million of a 30-year mortgage, you sell it off, you know, that's predictable cash flow for the insurance companies.
Yes.
But on how do you like securitize a 1-year hard money loan was always like, I was trying to wrap my head around that a lot, especially when they're fix and flip loans and they can pay off in 3 to 8 months, 3 to 6 months, you know? So how do you create predictable cash flow for the insurance companies?
You know, I don't understand that. So for me to say that, but my opinion on it is, you know, it has a lot to do with the points and the velocity, right? When you have billions of dollars that you're churning through that quickly, you know, think about it. If you have $1 billion and you make 1% on $1 billion, you created a lot of revenue. You know, they're volume-based companies.
Well, I think it's actually the replacement of the loans on like, they're almost like credit facilities where like if a loan's paying off, so you pledge $250 million in hard money loans. Yeah. And let's say every month, 30 million is paying off.
Right.
Well, you actually have to originate another 30 million to replace. Absolutely. Just like a credit facility, you have to replace the loans.
Right.
So to me, that's, if you're pledging a $250 million worth of loans, you know, statistically, if you have an 8-month turn rate, then you really have to originate like $350 million a year to keep the $250 million tranche intact.
Yes.
So less about margin to me and more about velocity of like quantity of deal flow that's needed, which again, when there's more money, there's more demand to push. And right now we're in a tough market, right? So there's arguably less deal flow that's being seen by lenders. So if you have an increased demand to keep cash out, but you have less deal flow, creates like it's driving costs down, right?
Absolutely.
And so I think that's a lot of stress. That's why they also talked about a lot of like liquidation or liquidity is what I meant.
Yeah.
Because if you can't replace the volume because you don't have the loans, you have to bring cash to the table or reduce the securitization.
Right.
And so like lenders need to be liquid in that way,
right? Which
I thought that was really interesting to me. And so how does that, and they're trying to do more and more tranches. So as you do 1 tranche, 2 tranche, 3 tranches, and then you have that demand to fill the tranches each time.
Right.
You know,
but there's a chance that it may not get filled. But also think about the pivot for the NPLA. Never had brokers involved before. It was just lenders and servicers.
Bingo.
But what happens this year? A bunch of brokers were invited. I mean, selective ones, not everybody. But then they're also doing one in the Atlantic City, which is going to be mostly broker based.
Yep.
So, you know.
Yeah. And why? How do you correlate that to?
Yeah. And how you correlate that to generating business. And then you also have the big.
More loans.
Yeah.
Need more loans. They're pushing brokers to fulfill those loans.
Absolutely. And then yet again, for loan products, white labeling versus corresponding lending. Those were big discussions in the NPLA.
So what is white labeling?
Yeah. So white labeling is you'll have, a hybrid institution. For example, I'll use Churchill because they were big at the NPLA. So Churchill will provide a white labeling product where a broker can still use their letterhead or their company name, or someone like DKC can use DKC letterhead and logo with their documentation, fund the loan using our name, but using Churchill money. So it looks like it's DKC money. It looks like that lender's money. But at the end of the day, the other institution will fund it, service it, and manage it throughout, the course of its origination and satisfaction. So the broker can actually, I won't use the word pretend.
Present.
They can present themselves as a lender.
Yeah.
But I would ask
without raising capital per se. I mean, they are raising money from the Churchills of the world, but.
Right. And I don't necessarily believe it is the best thing. I have my own opinion on it, but
this is our podcast, so you say it.
Yeah. Well, I think the big thing with that is, being a broker, because I was a broker for many years, is not understanding the servicing and the operation of it. It's really difficult to guide borrowers not understanding that component.
Yeah.
Because you have to be able to explain to them the challenges they're going to face if they're not an experienced person. And there's a large component for new investors into the market. So if you can't actively guide them through servicing how their payments are going to be projected, what they're to expect, as a broker, sometimes a lot of them will care about closing and that's it. Then it's good luck after that. So white labeling, to me, it's not a terrible thing, but I believe people should understand how it is to service, how operations looks like, and how they can forecast for borrowers. That's my personal opinion.
No, yeah. Well said.
How you feel?
No, that's well said. I agree.
Yeah.
I think that there's even like buybacks too. Like if
that's huge.
That's interesting for brokers that are white labeling. I mean, there's a good chunk of them that have to, like if a loan defaults in the first 3-6 months, some are a year. I mean, there's different criteria that you have to like buy the loan back.
Right.
So I think you have to have liquidity. And then in this market, there's a higher percentage of defaults statistically than there was 5 years ago.
Right.
So how does that affect the market? And also there was an emphasis, and it's a cautious one, and it's true. And even for us right now, when you have demand to get capital out, and it's a tough market and you're seeing more challenging deals, you don't want the pressure to get capital out to force you to make a bad decision and fund a bad loan.
Right.
And that's how you can go out of business. Right. And I mean, from somebody who was active in the 2008 market crash, like they basically graded paper poorly and suffered the consequences. I mean, there was a lot of things going on, but
I mean, look, we all know 2008, there was a lot of fraud in various different ways, but you're exactly right. Is the second they had a small box, then deals got slow. So the box got bigger. And then all of a sudden the paper, that should be A, that should be C, let's make it an A. And all of a sudden it got sold. So the demand really forced people's behavior. And we are seeing challenges in the market. I think it's obvious to everybody that deals are more creative now. There's still deals out there, but they're more creative.
Yeah.
But there is concern for that. But for us specifically, I know we are selective in what we're doing. And we always go back to our foundation of traditional lending to make sure that we stay secure in the investments that we're making and the deals that we approve. But yeah, I think, like you said, one bad decision on a bad loan can be the difference if you're in business or not. So going back to what we were talking about, white labeling, I think it's very important to understand servicing, underwriting, operations to make the selection on what is truly a good loan and why you should do it.
Yep. I love that. So then I guess another topic is how are we competing in the market? What kind of products are we rolling out?
Well, I would reverse that to you because as of recent, we collaborated, but you really brought to the forefront non-Dutch new construction loans for us.
Yeah.
And I think that's a really great change for us as an organization, but it took a lot from servicing component and how to design the loan. Because it's not just like, I want to do this loan today. That's not how we wake up and do it.
I wish it was that easy.
You know what I mean? And a lot of people forget that. They're like, you just can't provide this product. And I'm like, well, yes, it might be available for some organizations, but there's manpower, there's design, there's servicing, there's cost, there's all these things, underwriting.
Capital raising, most importantly.
Well, yeah.
Got to have capital that can,
support that request.
Yeah, support the request.
So how did that come about, and what new loan products do you foresee doing now and in the future?
Well, it's certainly market driven. And so I guess the product that we're mentioning right now is it's new construction, non-Dutch interest loans.
Yes.
So previously and currently still to a degree, we have our new construction loan product is Dutch interest, meaning you're paying on the full loan amount from day one. So if it's a $200,000 loan and your first draw is 50 grand, you're going to pay on 200,000. So if it's 12%, you're going to pay $2,000 a month. You have access to the money, but you're only, you only have the 50 grand in this scenario at day one.
Yeah.
So non-Dutch, meaning if you have a $2 million loan and you only get $500,000 at the initial funding, you're paying on $500,000.
Correct.
So that's just to identify what the difference is. And you can imagine from like as you raise capital, if it's private capital and you're saying, hey, Mr. Investor, I need you to send us $200,000, but you're only going to earn interest on 50K, and you can't do anything else with the money because it needs to be available for the borrower when they do a draw request in 24, 48 hours. Right. It's a tough sale, right?
Oh, that's a very hard sale. I've heard you do it many a time because it's difficult.
Yeah, I mean, it's almost impossible. It is, to me, because they could put their money in a money market and when you blend returns like that, when you have 200 grand, but you're earning interest at 50 grand, I mean, you're basically looking at a blended rate, and the blended rate is not in favor of, it's comparable to a money market with less risk. So that's where it's like, it gets to become a really, really difficult sale. Like I said, almost impossible. So the non-Dutch interest, we were able to structure it in a different way. And operational for us, it needs to be a larger loan amount. So I'm going to start and preface that. Like, we're not doing non-Dutch interest loans at 200,000, but at $1 million plus or $2 million plus, that's kind of where we're drawing the line of, if it's a multi-million-dollar deal, we will do non-Dutch interest. And it makes sense because financially, these sub-$1 million non-Dutch loans, they're still financially feasible for the borrower, and we're borrowers too. We borrow this type of money. And so speed and velocity matter. So when you're, paying on 200,000, but you only have 50K, if you're going to draw all the funds down in 3 to 6 months, you can manage that. It's $2,000 a month, six months, it's $12,000. That's the cost to get the interest, so that's feasible for those deals. But very much so, we had Mike Jones on the podcast and talked about how even when we're developers, once you get past that $1 million mark, then the Dutch interest kills the deal because the cost of money is so expensive versus the project, and the ROI is diminished. So I think that it makes sense for the borrower at that point and we were seeing it. We couldn't capitalize on the loans, new construction over $1 million for that reason. We understand why. So if we can offer that product $1 million plus, it's operationally, we can handle it. We can raise the capital in that manner, and it works for the borrowers.
Yeah, and I also believe it was great timing because, yet again, deals origination gets a little slowing up. So you have to open your box a little bit, change and adapt to the market, because I believe we're very adaptive to the market, strategically at least. And the demands are there. And
to do it in a way, as your point earlier, to do it in a way where you're not creating more risk either for the investors, and you're still making good loans. And we believe that they're great loans for our investors still, and they're great loans for the borrowers. They're competitive against the institutional financing. And so when you're 1-2% difference than the institutional loan, and you have more flexibility, you're direct to lender, and even on draw modifications, and the process is 50% easier. I think it's a really competitive product, and we've already seen that in the few weeks that we've had it.
Yeah, and I also think because at the NPLA, the same as the last 2 years, they said new construction is really where they're going, where the market demand is.
Yeah. The new construction and the DSCR, I guess, are the two top products, would you say?
Yeah, they were pushing both of those products quite heavily. A lot of new lenders. Before, I wouldn't say there was more hundreds of lenders. There were thousands of lenders that were in the market. And yet again, we moved from a couple $1 billion to we're going to be 10 billion plus by the
12,
end.
12.
Yeah, so it's a very well capitalized industry.
Yeah, and I feel great. I know you do as well about us filling that niche. When we were at the NPLA, if there's 1,000 lenders, we were in the 1 to 5% that are traditional asset-backed lenders. Yeah. So the majority of the markets, to me, seemed like it was going to the institutional hybrid product where you need credit, appraisal, experience, liquidity, and so I think the amount of lenders that are doing traditional asset-backed loans are less.
Yeah, and I like that about us. When everyone's going right, we're going left.
Yeah,
and but we still take the good things that each bank is doing, and we adapt it to our business as well if it fits.
Yep.
So I think that's really big with us.
Awesome.
Where do you see us traveling? With these changes, and now that MPLA is giving us a little bit more insights, and now we realize that we're going to stay true to us in asset-backed lending. Where do you see DKC going?
Yeah, I think from a perspective of like the products, we're pretty fixed on our products, especially with the new product we just rolled out. I think there's markets that we can grow into. So I think there's opportunity for us to grow into other markets like we've spoke about Georgia and Tennessee and Alabama and Louisiana. So we've spoken about growing into more markets. Also, just operationally, we're very focused on trying to create a better product, better customer experience, and so I think the market will always tell us where we go at the end of the day, and we'll be quick to respond to that as we are studying our data analytics.
Yeah.
But there's no doubt that hard money lending is changing forever, and so this institutional, securitization, it's big news. It's been a very traditional private sector, and now it's a significant asset class for institutional investors, and that's a big deal.
Yeah, I think what's super mainstream is the word I would use.
That's a great word.
I think at this point, investors have identified what the type of lending that's out there, and I believe this has replaced the subprime market. I've said it on several of our podcasts.
Yes, totally true.
And I believe this is really a better replacement because what a lot of people need to remember is those loans are based off of the cash flow of the asset. A lot of these DSCR loans. So before, where it was no income, no asset, you stated, and there was no rhyme or reason of why the income was there, I believe these loans are a lot more stable because they are based off true cash flow. So that's, a lot better for the market moving forward.
Yeah.
But
love it.
I really do. I think we're in a great place. But capital markets too. Do you want to talk anything about the capital markets and how DKC is adapting with that in general in our offerings?
Yeah, I mean, we're certainly partnering with other brokers and capital sources to just assist our borrowers with more products. That's the short answer. If you're looking to get off of our books, our 1-year hard money loans, and you didn't come to us through a broker, we are looking. We can help procure DSCR loans and these hybrid loans as a broker. So help facilitate these loans. It makes us more adaptable to the market, but we're offering more products to our borrowers, and it helps reduce the risk for our investors at the same time. And so if the group that's servicing your 1-year bridge loan can also help you with your long-term debt, it makes a lot of sense. And so that's something that we're growing, and you'll hear more about in the market here coming up soon as we start to advertise that product.
For sure. And I think it's also changing. I know for me personally on our side of the sales, it's changing how we present our sale because, we're understanding more of how to get people out of the loans. So where they're going and what they're going to need to qualify, and we can kind of prep them for what's ahead.
Yep.
And even assist our brokers who are referring the deal because they have to do the end sale when getting the client out. So we can kind of prep them, hey, your broker's going to need these kind of docs. This is where you're going to have to go. You have to make sure to have this type of credit score. So we can kind of advise and counsel in that way to make sure that they're in the best position because 12 months happens fast.
Oh, yeah.
And people you close your eyes, open your eyes, and the project should be done. Like it's that quick.
Yeah.
And at least I feel that way.
Very good. Well, we'll leave it there for today. Big updates, big market changes, big news. This will certainly be a theme that we continue to speak about. I think so.
And uncertainty equals opportunity. We're still here to make deals.
There we go. All right. Thanks everybody for joining us. We appreciate it.
Bye-bye.
Thanks for joining us for another episode of How to Make Money with Hard Money. Like, subscribe, and follow us on all social media platforms. You can catch this podcast on Apple Podcasts and YouTube.